Welcome back to another video. Today, we're going to explain a 3-step technique that will help us avoid, identify, and stay safe from fake breakouts. But before we dive into it, let's look at a quick scenario. So, what's happening here? As we can see, there's a resistance zone in place. This resistance zone initially gets broken, but that breakout fails. It turns out to be a fake breakout. Buyers get trapped at that point. Later, we see another fake breakout at the same level. But finally, we do get a real breakout from that very zone. Now, when the real breakout happens, the move continues upward and also breaks another resistance zone. If we go back and look, we can clearly see that second resistance level. That zone also gets broken. But this time, it comes down. We see a pullback. We don't know exactly how far the pullback will go, but the point is, it happens. So basically, if we had entered on this breakout candle, our stop loss would have already been hit. That's something we really need to understand. So now, the big question is, what's the logic here? Why does a fake breakout happen at this zone first, then a real breakout later, and then again a fake breakout at the next zone? We're going to explain all the reasons and logic behind this in this video. We'll break it down into 3 individual steps, and we need to understand each one carefully and apply it in the live market. Only then will we truly understand how to trade real versus fake breakouts. Step 1. Where did the breakout start from? Whenever we see a breakout, the first thing we need to check is where that move actually started. How do we check this? Let's say we're looking at a resistance zone. Now, we need to ask, did the breakout move begin right from here, or did it start way down below? That's super important. Suppose the move started all the way from the bottom. Buying pressure has been building from deep down. We already know that market price always moves in a zigzag pattern. So, if a strong buying wave has already happened, then the breakout point becomes an exit point for a lot of those earlier buyers. This means when price reaches that resistance zone and breaks it, we're likely to see a pullback. It's mandatory for a pullback to occur in this kind of situation. The market never keeps going up without any pullback, or if it does, it's extremely rare. So, when the buying move starts far from the breakout point, a pullback is almost guaranteed. If we enter on that breakout candle, we're basically entering right where others are booking profits and exiting, and that can easily trap us. Scenario 2. The move didn't come from deep below. What if the buying momentum didn't come from way below, but started just around the current resistance zone? In that case, a pullback might still happen, but it will likely be a smaller one. It could just be a quick retest of the breakout zone, which has now become a support, to shake out weak buyers before continuing the move upward. Sometimes, the market may even move up directly from there. But when does that happen? When the buying move didn't come from very far below. We'll also explain later why some buying moves start low and some don't. That'll come in the next steps. So, that's the theory part. Now let's check how this plays out in a live chart example. Look here. We've got a real breakout happening. Where did the buying start from? It started right from here, not from deep down. Before that, there was a weak selling phase, and then this breakout occurred. Did a pullback happen? Yes, we can see a red candle, a small pullback that touches the breakout zone, retests the previous resistance, and then the market moves upward again. That's how a real breakout behaves. Now, let's look at another scenario. A fake breakout. Here we see a resistance zone being broken. But notice what happened before that. The market started its move from way down, from near a strong support level. It pushed all the way up without any pullback. Now, when it reaches this resistance and tries to break it, this is where the trap happens. Why? Because all the buyers who entered along the way, they're either looking to scalp with tight stop losses or ride the breakout for a long move. Now, if price forms a fake breakout candle, goes up and then closes back below, all of those buyers get trapped. And what follows? A sharp sell-off. So, does this happen every time? If the buying pressure is extremely strong, even this long move from the bottom can result in a real breakout. But most of the time, when the market travels a long way before hitting resistance, the breakout is more likely to be fake. So make this your thumb rule. The longer the distance the market travels before hitting a breakout zone, the higher the chance it's a fake breakout. Step 2. Volume analysis. To identify fake versus real breakouts, price action alone isn't enough. We need to look at volume too. If the breakout is genuine, the breakout candle should have high volume. Why? Because a strong breakout needs to be backed by institutional power. If there's no volume behind the move, it's weak and may not sustain. Another thing to note, sometimes volume is high before the breakout candle but low on the actual breakout. That can also be a trap. So always check volume in 2 places. 1. On the breakout candle. 2. On the previous 2 to 3 candles. If the volume is consistently increasing, we can trust the breakout more. Step 3. Behavior of the retest. Now let's say a breakout happened. We've already checked the volume and we've seen where the move started. We should wait for a retest. Now listen carefully. The quality of the retest tells us if the breakout is real or fake. How? If the retest comes slowly, with small-bodied candles and low volume, and price touches the support and bounces, that's usually a real breakout. But if the retest is forceful, with large red candles, and it looks like price is trying to break support again, that's a sign of a fake breakout. Also remember, not every breakout gives a retest. Some just take off immediately. But whenever you do get a retest, don't ignore it. It's a valuable signal. If we apply all 3 steps properly, we'll be able to identify real versus fake breakouts 90% of the time. Let's quickly recap. 1. Where did the breakout start from? If it came from far below, be cautious. 2. What does the volume say? If volume is low, there's a higher chance it's fake. 3. How is the retest behaving? If it's smooth and controlled, it's likely real. If we've understood these 3 steps clearly, the next time we sit down with a chart, we won't fall for fake breakouts. Instead, we'll watch others get trapped. And that's the mark of a professional trader. If this video helped, make sure to like it. And if you're new to the channel, don't forget to subscribe. See you in the next video. Until then, take care and bye.